Hello, everyone. Today we're going to talk about one of the most important topics for anyone looking to grow their wealth and secure their financial future: gaining exposure to the S&P 500 index. Now, I've always said that the stock market is a device for transferring money from the impatient to the patient. And when it comes to patience, the S&P 500 is one of the best investments you can make. The S&P 500 represents 500 of the largest companies in the United States, companies that drive innovation, create jobs, and power the global economy. If you're looking for a way to invest in the long-term growth of America's economy, the S&P 500 is the place to start. But how do you invest in it? What's the best way to gain exposure to this index? That's exactly what we'll discuss in this video. We're going to break down the 5 best financial instruments for gaining exposure to the S&P 500. Along the way, we'll look at their advantages, their disadvantages, and who they're best suited for. So, let's get started. The first instrument on our list is the SPDR S&P 500 ETF Trust, also known as SPY. Now, SPY is the oldest and most widely recognized exchange-traded fund, or ETF, tracking the S&P 500. It was launched back in 1993 and has since become one of the most popular ways to invest in the index. Why is SPY so popular? Well, for starters, it's easy to buy. Stick with me for the next few minutes, and I'll break it down for you in a way that actually makes sense. Let's go. You can purchase SPY through any major brokerage platform, whether you're using Fidelity, Schwab, Robinhood, or another service. It's also highly liquid. Every single day, billions of dollars worth of SPY shares are traded. That means you can buy or sell it quickly, and you'll always have a buyer or seller on the other side. SPY is also tax efficient. Because it's an ETF, it minimizes capital gains distributions, which means you'll pay less in taxes compared to something like a mutual fund. And it closely tracks the S&P 500, so you know you're getting the performance of the index. But SPY isn't perfect. Its expense ratio is 0.09%. Now that's not a lot, but it is higher than some of its competitors, which we'll talk about in a moment. And like all S&P 500 instruments, SPY is fully exposed to market volatility. If the market goes down, SPY will go down with it. So who is SPY best for? It's ideal for anyone looking for a simple, reliable way to invest in the S&P 500. Whether you're a beginner or an experienced investor, SPY is a solid choice. Second, we have the iShares Core S&P 500 ETF, or IVV. This ETF is managed by BlackRock, one of the largest asset managers in the world. IVV is very similar to SPY, but it has one key advantage: it's cheaper. IVV's expense ratio is just 0.03%. That's 1/3 of SPY's expense ratio. Over the long term, those lower costs can make a big difference, especially if you're investing significant amounts of money. IVV is also tax efficient, just like SPY, and it's highly liquid. While it doesn't trade quite as much as SPY, it still has plenty of volume for most investors. Now, there are a couple of drawbacks to IVV. First, its trading volume is slightly lower than SPY's, which could be a consideration for very large trades. Second, like SPY, dividends from IVV are taxable in non-retirement accounts, which can reduce your after-tax returns. So, who should consider IVV? It's a great option for long-term investors who want to keep their costs as low as possible. If you're planning to buy and hold for years, IVV is an excellent choice. The third instrument on our list is the Vanguard S&P 500 ETF, or VOO. Vanguard has built its reputation on offering low-cost investment options, and VOO is no exception. Like IVV, VOO has an expense ratio of just 0.03%. That makes it one of the cheapest ways to invest in the S&P 500. VOO is similar to IVV in many ways. It's tax efficient, it closely tracks the S&P 500, and it's widely available on major brokerage platforms. However, VOO does have slightly lower trading volume compared to SPY. For most investors, this won't be an issue, but it's something to keep in mind if you're trading large amounts. So who should invest in VOO? If you're a long-term investor focused on minimizing costs, VOO is a fantastic choice. It's particularly well-suited for those who appreciate Vanguard's investor-first philosophy. Our fourth pick would be a mutual fund. specifically the Fidelity 500 Index Fund, or FXAIX. Unlike ETFs, mutual funds don't trade on an exchange. Instead, they're bought and sold directly through the fund provider, and trades are executed at the end of the trading day. FXAIX is one of the best S&P 500 mutual funds out there. Its expense ratio is just 0.05%, which is even lower than the ETFs we've discussed. That makes it an incredibly cost-effective option for long-term investors. It's also a great choice for retirement accounts, like IRAs or 401ks, where dividends and capital gains are not immediately taxable. However, mutual funds like FXAIX do have some drawbacks. They lack the flexibility of ETFs because you can only trade them at the end of the day. And in taxable accounts, mutual funds may distribute capital gains, which can result in higher taxes compared to ETFs. So, who should consider FXAIX? It's ideal for retirement accounts and for investors who don't need the intraday trading flexibility of ETFs. If you're focused on minimizing costs and maximizing tax efficiency, FXAIX is a strong contender. Finally, let's talk about direct indexing. This is a more advanced strategy that involves buying individual stocks in the S&P 500 to replicate the performance of the index. With direct indexing, you own the underlying stocks, which gives you more control and flexibility. One of the biggest advantages of direct indexing is tax loss harvesting. If one of the stocks in your portfolio goes down, you can sell it to offset gains elsewhere, reducing your tax bill. Direct indexing also allows for customization. For example, you can exclude certain stocks or sectors that don't align with your values or investment goals. But direct indexing isn't for everyone. It requires significant capital to replicate the S&P 500, and managing 500 individual stocks can be complex. It's also more expensive than ETFs or mutual funds, with higher transaction costs and management fees. So, who should consider direct indexing? It's best suited for high-net-worth investors who want more control over their portfolio and are looking for advanced tax strategies. If that sounds like you, platforms like Schwab Personalized Indexing and Wealthfront offer direct indexing services. So there you have it, 5 of the best ways to gain exposure to the S&P 500. Whether you choose SPY, IVV, VOO, FXAIX, or direct indexing, the key is to stay patient and stay invested. As I've said before, the stock market rewards those who think long-term. The S&P 500 is a reflection of America's best companies, and over time, it has proven to be one of the most reliable ways to grow wealth. Remember, the best investment you can make is in yourself. Take the time to understand these instruments, consider your financial goals, and choose the option that's right for you. And if you're ever unsure, don't hesitate to consult a trusted financial advisor. Thank you for watching, and if you found this video helpful, be sure to like, subscribe, and share it with someone who's looking to invest in their future. Until next time, happy investing.